What's up guys? In this video, I wanted to talk about correlation and why it doesn't really matter when it comes to yield farming concentrated pools. In my opinion, it's one of the most misunderstood topics, similar to impermanent loss. So if you're not really thinking through the correlation really carefully and what it means, it could actually lose you a lot of money when you guys yield farm. If you're new here, my name is Richard. I'm a yield farmer and investor. And just before we begin, here's a quick portfolio update. Still doing relatively well with my core portfolio here. Some of these positions have retraced a little bit, completely normal, especially for a lower cap altcoin. Ethereum has been really strong here. But overall, you can see I'm beating impermanent loss and holding in the market by quite a huge margin. My main closed position still sits at a 8.61 Ethereum profit. So pretty decent track record. Hopefully these videos help you guys make more profits as well as avoid some of the mistakes that I've made. And just a quick disclaimer, none of this is financial advice. So please do your own research before making any investment decisions. So before we actually discuss why correlation doesn't matter, I want to explain a little bit of what correlation is. Correlation is basically if an asset is moving together or not. You can read this here. This is the DeFi Llama correlation tool. And what it measures is that if a token tends to move together or not. This is using the price action of each day to basically calculate the correlation. So if a token tends to move together, meaning that they close at a gain or a loss together, they would have a higher correlation score, right? The closer to 1, the more correlated it is, and they do tend to move together in that direction. The way people use correlation when it comes to yield farming is they try to find highly correlated tokens, pair them together to try to minimize impermanent loss, right? In theory, it sounds great, but there's a couple big problems when it comes to correlation. The first problem is correlation only shows you which direction they're moving together on, or if they're moving together on that same day. It actually doesn't measure how much the move is. So let's say Ethereum goes up by 1%, but let's say one of these tokens like Pendle goes up by 10% on the same day. They both close at a gain. They are highly correlated in that case. And then the next day, let's say Ethereum goes down by 2%, but Pendle goes down by 20%. In that case, the correlation is still positive, right? Because they move in the same direction. But it absolutely does not tell you the volatility of the token, which directly impacts impermanent loss, right? If you guys run very tight range strategies, but the token is very volatile, it moves you out of range all the time, you're suffering a ton of impermanent loss, right? Especially if it's a trending token, meaning that the token is either trending up or trending down over time, you're still going to be suffering a ton of impermanent loss. The correlation would not matter in this case at all. It doesn't tell you how much the token is correlated by. The number 2 problem is that this is a lagging indicator, right? It's taking the past data to compute this correlation metrics. But here's the problem, right? Correlation can break at any time. If you guys look at my correlation videos that I've released in the past, Bitcoin and Ethereum was actually less correlated than this in the 1-year time span. So this number is slowly rising to 0.35. In 2024, before Ethereum broke down against Bitcoin, this number was actually way higher than this, higher than 0.5. If we look at the ETH to Bitcoin chart, this is the breakdown that I was talking about. There's a huge decline here in Ethereum's value against Bitcoin. So it was showing a pretty high correlation back here, but it actually does not tell you what's going to happen in the future, right? So if you guys were running very tight ranges like this, let's say in the beginning of last year, you would absolutely get destroyed by impermanent loss and get blindsided by the drawdown. So this is exactly what we want to avoid here. It does not show you the trend. It does not show you where the correlation is heading. It's just a metric based on the past. And we know that the past performance never guarantees the future. Just because a trend is a trend doesn't mean that the trend would not break, right? If we look at the Sol to Ethereum chart, you can see Solana actually has been outperforming Ethereum for quite a while until very recently the trend started to break down. So just because a trend is a trend, people say stuff like, a trend is your friend, right? Doesn't mean that the trend would not reverse. especially if a trend is very drawn out here. If you guys measure the uptrend, the trend is very drawn out, and the longer the trend stays, the more likely it is to reverse on the other side. So correlation actually does not tell you when the trend would break. And the third problem with correlation is that a higher correlation number doesn't mean that the token is better to buy. For example, if we compare Uni to Pendle here, Uni has a higher correlation compared to Pendle, 0.86 to 0.74 on the 1 year time span, right? But if we look at the 1 month time span, you can see it's pretty similar, 0.98 to 0.96, but over 1 year, Uni has better correlation when we compare it with Pendle. But does that mean that Uni is a better token to buy compared to Pendle? This is not the case, right? Because we're basically ignoring the fundamentals and we don't know where the price is for each of those tokens either, right? Let's say Pendle is trading here at this 0.0012 mark. If we use Ethereum as our quote asset here, if I turn off the log chart, the chart actually looks pretty good, right? It's still moving sideways here. There are periods of underperformance against Ethereum and then outperformance against Ethereum. If we look at Uni's chart, you can see similar things as well. There are periods of outperformance and then underperformance. So correlation doesn't really tell us like, okay, which token is better to buy. Just because it has a higher correlation score does not make it a better buy, right? And the fourth reason why I don't like using correlation at all is because we don't actually need the token to move together to make a lot of profits. And I will show you guys the example of Pendle here. So if I overlay the Ethereum chart with the Pendle chart, you can see in April and May of this year, Ethereum was on a strong downtrend here, while Pendle was on a strong uptrend, right? So in this case, does that mean that we should not be yield farming this pair? That's not the case at all. So if I turn back to this Pendle to Ethereum chart, what you can actually see is that if you entered back here, and then you ride the swing upwards where Pendle outperforms Ethereum, Ethereum is still moving down while Pendle is moving up, right? By definition, that's a negative correlation. So if you were yield farming this pair like I was, you were actually able to capture this upswing, have a bunch of positive Ethereum divergence loss, and close out this position at a profit. If you guys look at my close position here, this is exactly what I did. You can see I suffered a 0.6 ETH of positive divergence loss, meaning that my LP value grew in Ethereum's term, while I earned a lot of fees in the process, 0.46 ETH, putting a net total profit at roughly almost 1.1 ETH. If you look here, I deposited February 11th, exited the position at April 3rd. And I didn't really have like the perfect exit either. I exited around here. It was still above my entry at that point in time, while I was able to make a decent amount of Ethereum profit. And then as Ethereum trends back up again in this blue line here, I'm able to actually secure more and more US dollar profit, right? So we don't need correlation at all to actually make a profit in the market. So why are we relying on it? In fact, it's often good to have uncorrelated assets to balance out your portfolio because sometimes one asset is going down while the other asset is going up. That's actually allowing me to profit from that difference, right? When Pendle is outperforming Ethereum, I swap more of my Pendle into Ethereum. And then when Ethereum is underperforming Pendle, I swap some of my Ethereum back into Pendle to stack more Pendle, right? And then I repeat that process over and over again. And that's why I'm yield farming this pair right now as well. Ethereum is being really strong. Hopefully Pendle catches up. And that's what I'm betting on here with this entry. And then if this chart does swing back up again, I could secure more Ethereum profit once again. So do we need correlation? Not really. And I just find it to be more of a distraction rather than a useful tool. And the fifth reason why I don't rely on correlation is because most of the time, crypto assets tend to move together. If we look at the others chart compared to Ethereum here, so others is basically all of the altcoins, excluding the top 10 crypto. And you can see if you just overlay it with Ethereum chart, they tend to move in the same direction, right? Like when Ethereum is struggling, altcoins tend to struggle. When Ethereum is pumping, altcoins tend to pump. But sometimes there's outperformance and underperformance, right? For example, back up here, it's kind of keeping up with Ethereum. And then the second pump of Ethereum, others did not keep up. And then back here in December, others actually outperformed Ethereum. Ethereum saw a huge decline, so others held up better in value. And now Ethereum is outperforming other altcoins once again. So it's moving pretty much in like the same direction. Again, correlation doesn't really show you like the outperformance. It just shows you if it's moving in the same direction. And crypto, most of the time, in the context of like altcoin yield farming, they all tend to move together. And we never know if the trend is going to break. Stuff like Ethereum to Bitcoin, Ethereum to Solana, a lot of times these trends tend to shift, especially if the trend has stayed for a very long time, right? So if correlation doesn't work, then what do we use instead? I personally like to use relative strength. If you guys have been watching the channel for quite a while, you guys know I talk about relative strength. If we look at Pendle compared to ETH here, you can see this tab. I could compare its performance against Ethereum. I could look at Bitcoin as well. You could see Pendle compared to Bitcoin. If we start from January 2024, you could see Pendle outperform Bitcoin, underperforms it, outperforms it, and then underperform it once again, outperforms, underperforms. This is how most altcoin charts look against either Bitcoin or against Ethereum. There are periods of underperformance. That's when I come in and try to get my entry. And then when it outperforms once again, when the token is really pumping hard against these major assets, I will be securing more and more of my profits, right? And then when it's underperforming once again, meaning that it's cheap relative to the quote asset, in this case is Bitcoin, then I want to buy more of these tokens once again, right? So if we look at Pendle to Ethereum here, the chart is actually much cleaner. You can see it's crabbing sideways against Ethereum. So if we just position ourselves when this token is weak against Ethereum, we could likely see an outperformance by Pendle, especially when Ethereum starts to slow down. People rotate their capital to smaller cap altcoins. This is when I can bet on Pendle's outperformance. And then when Pendle seems to be topping out, I could choose to exit my position completely as well. So that's relative strength. I like to look at like how the token is doing compared to the quote asset that I'm pairing with. If you guys are yield farming Solana pairs, you might be using Solana as the quote asset, right? One example of a pair is Radium. If you guys are yield farming Radium and Sol, we don't want to buy a ton of Radium with our Solana at a high price, right? When Radium is expensive against Solana, we don't want to buy a ton of Radium. But if Radium is very cheap against Solana, that's when we could enter into the pools if we're trying to bet on the outperformance of Radium. And if you guys don't believe that the token is going to outperform the quote asset, then why are we taking that extra risk in the first place, right? And what I like to do as well is to compare the performance against the index and the category leader. So for Radium, I want to look at the others chart. So Radium divided by others. And if this chart goes up, it means that Radium is outperforming a lot of other altcoins, right? This chart actually looks pretty good. On the weekly chart, it's on a longer term uptrend here, potentially going upwards, but there are some period of time where the chart is really strong. That's when we should be securing most of our profits here. But you can see still look pretty decent. It's bouncing off of this 100-week simple moving average here and potentially swinging upwards. And we can take a look at, let's say, Radium against Uni as well. Radium is a DEX token, right? So we could compare it against something like Uni. And we can see Radium has been outperforming Uni for quite a while now. Maybe you could argue that the trend might be shifting here and maybe a lower low here. But we could also argue that it's like sitting on this zone of support here. So Radium could be strong against Uni still if there's a lot of hype in the Solana ecosystem. So that's my entire process of trying to bet on outperformance. Again, I want to try to position myself for the outperformance so that when I take profits, I could get much more return, right? And you can see with the analysis of Radium and Pendle, I didn't go back and look at correlation at all, right? Because I don't need to. It's not a useful metric in my opinion. It's just more of a distraction rather than a signal that you want to factor into your decision making. And if you guys want to minimize impermanent loss, what we actually want to look for is a less volatile pair in either a crabbing or a token that is on an uptrend, but the trend is not overdrawn yet, right? So let's take a look at some examples here. It's a very popular DeFi protocol. So if we look at ENA against Ethereum here, you can see when ENA went on an uptrend against Ethereum, if you actually entered here, you would have been able to capture this huge swing upwards, right? And even if you didn't take profits, if you entered back here, you would still be sitting in an Ethereum profit here if you guys yield farm with wider ranges. But ideally, when the token is starting to shift its trend, it's a good time to secure the profits, exit out of that position, and then when it's resuming its uptrend again, we could try to enter once again, right? Recently, it's on a pretty big uptrend here. If I have a lot of Ethereum and I'm looking into a altcoin pair, this is actually a pretty decent chart to bet on. I could either enter here fully or wait for a retrace to enter into this token. We want to avoid entering when the token is trending down because let's say I enter here at this green line. What's going to happen is that you're going to lose a lot of Ethereum in the process. You're going to gain Athena instead because this is the Athena compared to Ethereum chart, right? Whatever ETH you put in the pool is going to be converted to ENA. And then we have to basically compound our fees and drag down our entry and wait for a reversal before we could actually close our position for an Ethereum profit. And typically, I like to close my position into Ethereum if I'm yield farming Ethereum pairs because I want more Ethereum out of it, right? If I'm betting on a token, but I just keep bleeding out my portfolio in Ethereum value, then I might as well not be yield farming this pair. There's a lot of pairs to choose from, and I don't have to bet on a reversal or a token that is just bleeding out against Ethereum, right? And another token, if you want less impermanent loss to yield farm with, could be Uni. So if we look at the weekly chart here, the swing is pretty wild sometimes. You could see like 48 to 60% to the upside, sometimes like 30% to the downside. But you can see over a long period of time, Uni has been able to keep its value against Ethereum. So I'm not saying the fundamentals of Uni is solid, but just if you see this type of chart, you actually would suffer less impermanent loss if you guys have a range that is like this, or maybe slightly wider to give you some room for error, right? If you yield farm this pair with a fairly wide range here, you would actually not suffer that much impermanent loss, right? Especially if the APR on this pool is really good, then it could be worth it to do. Again, we don't want a token that is constantly bleeding out against Ethereum. This does not seem to be the case, but who knows, in the future it might. That's why we always hedge and diversify our investment. So I hope that makes sense, guys. In my opinion, people just misunderstand correlation. They rely on it too much when in reality, it shouldn't be like the core main factors when you're making decisions. I like to use relative strength instead, the fundamentals behind the token, the technical analysis, as well as a strong narrative to basically support my decision rather than just a correlation number, right? And if your goal is to minimize impermanent loss, just go on my channel and search for impermanent loss. There's a lot of videos that talks about impermanent loss. It's also one of the most misunderstood topics. So be sure to check those out as well. Thanks once again for watching. I'll catch you guys next time.